Most major financial shifts do not begin with headlines. They begin quietly, buried inside portfolio allocations, phrased in language that only institutional investors are trained to notice. In late 2025 outlooks, BlackRock, the largest asset manager on the planet, overseeing more than $10 trillion, used a phrase it has avoided for decades. It described itself as tactically underweight long-duration US Treasury bonds. At first glance, that may sound technical, almost boring. But when an institution of this size changes its posture on what has long been considered the backbone of the global financial system, the move deserves attention, not because it signals panic, but because it reflects a shift in how risk is being calculated at the highest level. This video is not about predicting collapse. It is not about fear. It is about understanding why the smartest capital in the world is adjusting quietly and what that adjustment tells us about the system we all operate inside. To understand why this matters, we first need to understand the language. When BlackRock says it is tactically underweight, it is not making an emotional decision. It is not abandoning treasuries altogether. It is saying that, relative to a neutral benchmark, long-term U.S. government bonds now present more risk than reward over the foreseeable horizon. This is crucial. Institutional investors do not think in terms of opinions. They think in terms of probabilities, liquidity, and duration risk. Long-duration treasuries are especially sensitive to interest rates. When rates rise, their prices fall, sometimes dramatically. For decades, falling rates made these bonds extremely attractive. That environment no longer exists. BlackRock's shift suggests that the asymmetric upside that once defined long-term treasuries has diminished, while the downside risk has increased. This is not a trade, it is a recalibration. And when a $10 trillion institution recalibrates, the implications extend far beyond its own portfolio. Smaller investors can rotate in and out of assets without consequence. Institutions cannot. When the largest asset manager in the world reduces exposure, it affects liquidity, demand dynamics, and pricing behavior across the entire bond market. Think of treasuries as the foundation of modern finance. They collateralize loans, stabilize pension funds, and anchor risk-free rate assumptions across every asset class. When demand weakens at the margin, the system does not break immediately. Instead, it becomes more fragile. This is why BlackRock's move matters, not because it signals disaster, but because it reflects a recognition that the old assumptions no longer fully apply. The question is not whether the system survives. The question is how it adapts. Smaller investors can rotate in and out of assets without consequence. Institutions cannot. When the largest asset manager in the world reduces exposure, it affects liquidity, demand dynamics, and pricing behavior across the entire bond market. Think of treasuries as the foundation of modern finance. They collateralize loans, stabilize pension funds, and anchor risk-free rate assumptions across every asset class. When demand weakens at the margin, the system does not break immediately. Instead, it becomes more fragile. This is why BlackRock's move matters, not because it signals disaster, but because it reflects a recognition that the old assumptions no longer fully apply. The question is not whether the system survives. The question is how it adapts. As of today, U.S. federal debt exceeds $38 trillion. That number alone is not the problem. The real issue is the interaction between debt, interest rates, and time. For years, near zero interest rates mask the cost of borrowing. Debt could expand without immediate consequence. But as rates normalize, the interest expense becomes unavoidable. Every year, a large portion of U.S. debt must be refinanced. At higher rates, that refinancing becomes more expensive, not incrementally, but exponentially. This creates a feedback loop. Higher interest expense increases deficits. Higher deficits require more borrowing increases supply, and supply requires demand. At some point, the math stops being theoretical. Not because of default, but because of sustainability. It is important to be precise here. The United States does not face a traditional default risk. It controls its own currency. The real risk is something far more subtle: erosion. Erosion of purchasing power, erosion of real returns, erosion of confidence in long duration promises. This is the environment institutional investors are navigating. Over the past decade, major foreign holders of US Treasuries, China, Japan, and Saudi Arabia have steadily reduced their exposure. This is often misinterpreted as a political statement. It is not. Reserve managers think like risk officers. They care about currency exposure, duration risk, and real yields. When inflation adjusted returns turn negative, holding long-term debt becomes a liability. As foreign demand declines, the burden shifts inward to domestic institutions and the Federal Reserve. This changes the character of the market. History shows that reserve currencies do not collapse overnight, they transition. First comes trust, then expansion, then leverage, then monetization. Finally, gradual neutralization. This process unfolds over decades. The dollar remains dominant, but dominance does not mean permanence. BlackRock's positioning suggests awareness of this phase, not alarm, but adaptation. Rather than long-duration bonds, institutions are favoring flexibility, shorter-duration instruments, assets with inflation resilience, real assets that preserve purchasing power. This is not about chasing returns. It is about maintaining optionality. In uncertain systems, flexibility is the most valuable asset of all. For most people, this will not show up as a dramatic event. It will show up slowly. Higher mortgage costs, lower real savings returns, pensions under pressure. The danger is not collapse. The danger is complacency. BlackRock is not predicting disaster. It is responding to mathematics, and mathematics does not negotiate. The smartest capital in the world is adjusting, not because it is afraid, but because it understands the environment has changed. The most dangerous belief in finance is that the future will look like the past. Systems evolve. Capital adapts. The question is not whether change is coming. The question is whether we are paying attention when it does. The most important thing to understand about financial systems is that they rarely break where people are looking. They change shape quietly under the surface while the public debates the wrong risks. BlackRock's move away from long-duration US Treasuries is not a headline event. It is a structural signal, one that only becomes obvious in hindsight. Once institutions begin adjusting, the process does not reverse quickly. Capital reallocations of this size move slowly, deliberately, and with long memory. What we are witnessing is not a rejection of the US bond market, but a repricing of certainty itself. Long-term promises are becoming harder to justify in a world where policy, inflation, and geopolitics compress the future into shorter and shorter cycles. To understand what comes next, we need to stop thinking in terms of crisis and start thinking in terms of transition. Bond markets do not collapse in a single moment. They thin. Liquidity becomes selective. Volatility concentrates around auctions, policy announcements, and inflation data. What once felt stable begins to feel conditional. As demand for long-duration treasuries weakens, the treasury market increasingly depends on short-term buyers and rollover financing. This shifts the entire yield curve dynamic. Instead of long-term confidence anchoring the system, the market becomes more sensitive to near-term policy signals. Every rate decision carries more weight. Every inflation print becomes more destabilizing. Stability gives way to responsiveness, and responsiveness introduces fragility. This is where the Federal Reserve's role becomes more complex. In previous decades, central banks could intervene quietly, smoothing volatility and restoring confidence. Today, intervention itself carries inflationary consequences. Each balance sheet expansion, each liquidity backstop reinforces the perception that monetary policy is no longer neutral. Markets begin to price no-3 policies not as stabilizers, but as trade-offs. As a result, the concept of the risk-free rate begins to erode, not because treasuries are unsafe, but because their real value becomes uncertain. When inflation-adjusted returns fluctuate unpredictably, safety becomes relative. Institutions respond by shortening their time horizons. They demand optionality. They prioritize assets that can be repriced quickly rather than locked in for decades. This shift changes how capital behaves across the entire financial system. Equity markets become more sensitive to interest rate expectations. Real estate pricing adjusts to higher discount rates. Pension funds struggle to match long-term liabilities with assets that no longer offer stable real returns. The system does not fail, but it becomes tighter, less forgiving, and more stratified. Globally, the consequences are even more subtle. The US dollar remains dominant, but its role evolves. Instead of being a long-term store of value for reserves, it increasingly functions as a transactional currency, used for settlement, trade, and liquidity, but not accumulation. Central banks diversify, not because they distrust the dollar, but because concentration risk no longer makes sense. This is how reserve systems transition. Not through dramatic abandonment, but through gradual dilution. Gold allocations rise modestly. Commodity-linked assets gain relevance. Regional trade agreements expand. None of this makes headlines on its own. Together, it reshapes the financial landscape. For the average person, these changes manifest quietly. Savings accounts lag inflation. Fixed income investments underperform expectations. The promise that conservative portfolios will preserve purchasing power weakens. People work longer, save more, and still feel less secure, not because of a single shock, but because the system demands more effort to maintain the same outcomes. This is the psychological cost of financial transition. When stability fades, even slowly, behavior changes. Households become cautious. Businesses delay investment. Governments rely more heavily on short-term funding solutions. Growth slows, not because of collapse, but because confidence becomes conditional. What BlackRock's positioning ultimately reveals is not a prediction, but a posture. Institutions are preparing for a world where certainty is expensive and flexibility is essential. They are not betting against America. They are betting against rigidity. And this is the critical insight most commentary misses. The danger is not that the system fails. The danger is that it continues, but in a form that rewards those who understand it and penalizes those who assume nothing has changed. Financial history shows that the most painful periods are not marked by chaos, but by adjustment. Wealth is not destroyed overnight. It is redistributed slowly through inflation, policy, and shifting incentives. Those who adapt early barely notice the transition. Those who do not feel like the rules changed without warning. As we move deeper into this decade, the bond market will remain central, but no longer unquestioned. Long-term certainty will carry a premium. Liquidity will matter more than yield, and understanding institutional behavior will become more important than following headlines. The real signal, then, is not fear. It is alignment. Capital is aligning itself with a world that is more volatile, more constrained, and more honest about risk. That alignment has already begun. And by the time it becomes obvious to everyone, it will no longer be actionable. One of the most misunderstood aspects of financial history is the idea that capital moves because of emotion. In reality, capital moves because of constraints. Fear may dominate headlines, but balance sheets dictate behavior. When BlackRock and other large institutions adjust their exposure to long-term US Treasuries, they are not reacting emotionally. They are responding to a system that has become more constrained, more complex, and less forgiving of long-term assumptions. In stable monetary eras, trust functions as invisible infrastructure. Investors do not need to constantly reassess risk because the framework itself feels reliable. Inflation is low, policy is predictable, and long-term planning makes sense. But when that infrastructure weakens, even slightly, capital begins to behave differently. It shortens its time horizon. It demands liquidity. It becomes less willing to trade flexibility for yield. This is the context in which the current bond market must be understood. The issue is not that US Treasuries are unsafe. The issue is that their future purchasing power has become harder to model with confidence. When inflation volatility increases and fiscal trajectories become less predictable, the certainty premium that once justified long-duration bonds begins to disappear. Institutions do not wait for confirmation of this shift. They position ahead of it. What follows is not panic selling, but gradual disengagement. Exposure is trimmed. Duration is shortened. Capital rotates toward instruments that can be repriced more frequently. This process is slow by design. Large institutions cannot move quickly without disrupting the very markets they depend on. Instead, they move early and quietly. As this adjustment spreads across the financial system, its effects compound. Yield curves become more sensitive to policy signals. Treasury auctions require more aggressive pricing to attract buyers. Volatility increases around macroeconomic data releases. None of these developments indicate collapse. They indicate friction. And friction is the enemy of leverage-heavy systems. Leverage depends on predictability. When future cash flows can be discounted with confidence, leverage feels safe. When those assumptions weaken, leverage becomes dangerous. This is why periods of monetary transition often coincide with financial instability, not because assets suddenly lose value, but because the structures built on top of them become less reliable. The Federal Reserve finds itself operating in this environment with limited options. Its traditional tools were designed for a world where inflation was dormant and debt levels were manageable. In that world, expanding the balance sheet carried few immediate consequences. Today, the same actions risk reinforcing inflation expectations and undermining long-term confidence in monetary discipline. This creates a policy paradox. Tightening too aggressively risks economic contraction. Easing too readily risks currency debasement. The result is a narrow path where every decision carries trade-offs. Markets sense this constraint. They respond by demanding higher compensation for uncertainty, particularly at the long end of the yield curve. As long-term yields rise relative to short-term rates, the cost of capital throughout the economy increases. Mortgages become more expensive. Corporate borrowing slows. Asset valuations adjust downward to reflect higher discount rates. These effects are not evenly distributed. Those closest to liquidity adapt quickly. Those dependent on fixed income and long-term promises feel the strain first. This is where the social dimension of monetary transition becomes visible. Systems built on stability begin to favor those with flexibility. Workers with adaptable skills fare better than those locked into static wage structures. Businesses with pricing power outperform those operating on thin margins. Governments rely more heavily on inflation as a silent adjustment mechanism, redistributing value without explicit policy changes. Internationally, these dynamics accelerate diversification trends already underway. Central banks do not abandon the dollar, but they reduce their reliance on any single reserve asset. Gold emerges not as a speculative trade, but as a neutral reserve, one without counterparty risk. Commodity exposure increases, particularly in countries seeking insulation from currency volatility. This gradual rebalancing does not signal the end of the dollar system. It signals its evolution. The dollar remains central to global trade and finance, but its role shifts from unquestioned anchor to dominant participant. In such systems, power is retained, but privilege is reduced. The ability to borrow cheaply, endlessly, and without consequence diminishes over time. For institutional investors, this environment rewards discipline over optimism. Capital preservation becomes as important as return generation. Risk management shifts from volatility suppression to resilience building. Portfolios are constructed not for ideal conditions, but for robustness across multiple scenarios. This is why narratives focused on sudden collapse miss the point. Financial systems rarely fail catastrophically unless forced by external shocks. More often, they adapt internally, redistributing costs and benefits in ways that feel invisible until they are widespread. Inflation erodes savings. Asset prices stagnate in real terms. Growth slows, not because innovation stops, but because uncertainty raises the cost of capital. For households, this creates a persistent sense of instability. Traditional markers of financial security, home ownership, retirement savings, fixed income investments, require more effort to maintain. People do not necessarily become poorer in nominal terms, but they feel less secure. Expectations adjust downward quietly, without formal acknowledgement. This psychological shift matters. Confidence is not just an economic variable, it is a behavioral one. When people lose faith in long-term promises, they prioritize the present. Consumption patterns change. Investment horizons shorten. Political pressure for intervention increases. Governments respond with policies designed to relieve immediate pain, often at the expense of long-term discipline. This feedback loop reinforces the very conditions that triggered the adjustment in the first place. Debt increases. Monetary tools are stretched further. Inflation becomes harder to control. None of this is accidental. It is the natural outcome of a system transitioning from abundance to constraint. BlackRock's positioning reflects an understanding of this transition. It is not attempting to predict exact outcomes. It is acknowledging that the distribution of risk has changed. In such environments, survival depends less on forecasting and more on adaptability. The most important insight, then, is not about bonds or dollars or even debt. It is about time. When confidence in the long term weakens, time itself becomes expensive. Capital prefers instruments that allow frequent reassessment. Flexibility becomes a form of insurance. This is why long duration assets struggle in transitional periods. They demand faith in a future that feels increasingly uncertain. Shorter duration assets, by contrast, align with a world where reassessment is constant and conditions change rapidly. Understanding this shift is critical because it explains behavior that might otherwise seem contradictory. Why do markets rally even as debt increases? Why does growth persist despite tightening financial conditions? Why does no single crisis seem decisive? The answer lies in adaptation. Systems bend before they break. Capital moves before it panics. Institutions adjust before narratives change. By the time the public conversation catches up, the transition is already well underway. When confidence in long-term financial promises weakens, capital does not disappear. It migrates. The destinations it chooses are rarely speculative in nature. Instead, they reflect a search for neutrality. This is where gold and commodities re-enter the discussion, not as dramatic hedges against collapse, but as structural tools for balance sheet resilience. For institutions managing trillions, these assets are not about outperforming markets. They are about anchoring value in a system where traditional anchors are slowly losing their certainty. Gold's role in this environment is widely misunderstood. Contrary to popular belief, central banks and large institutions do not view gold as a bet against the dollar. They view it as an asset without political obligation. Gold carries no counterparty risk. It cannot be sanctioned, defaulted on, or devalued through policy decisions. In periods of monetary stability, this neutrality is unnecessary. In periods of transition, it becomes valuable. What we are witnessing today is not a sudden rush into gold, but a steady normalization of its presence on institutional balance sheets. Allocations rise modestly, often by a few percentage points. These shifts attract little attention, but their cumulative effect is profound. Over time, Even small reallocations by reserve managers alter demand dynamics and price behavior, reinforcing gold's role as a long-term stabilizer rather than a speculative asset. Commodities serve a related but distinct function. Unlike financial assets, commodities are embedded in the real economy. They respond to supply constraints, geopolitical shifts, and infrastructure demand. In a world where inflation volatility increases, commodities act as a partial transmission mechanism rather than a hedge. They reflect rising costs instead of protecting against them outright. For institutions, exposure to commodities is less about price appreciation and more about correlation. When financial assets struggle under higher rates or tighter liquidity, commodities often move independently. This diversification benefit becomes especially valuable when traditional asset correlations rise, a common feature of stressed financial environments. The renewed institutional interest in real assets also reflects a deeper shift in how value is measured. In low inflation eras, nominal returns dominate decision-making. In inflation-prone environments, real returns take precedence. This changes portfolio construction fundamentally. Assets that generate steady nominal income but lose purchasing power over time become less attractive. Assets that preserve real value, even if volatile, gain relevance. This logic extends beyond gold and commodities into infrastructure, energy systems, and select real estate. These assets share a common trait: their value is tied to physical utility rather than financial abstraction. They cannot be easily replicated or diluted. Their cash flows adjust, often imperfectly, but meaningfully, to inflationary pressures. This is why institutions increasingly frame their strategies around resilience rather than optimization. The goal is not to extract maximum yield, but to remain solvent, liquid, and adaptable across a wide range of outcomes. In such a framework, long-duration bonds lose their appeal, not because they are unsafe, but because they are inflexible. At the global level, these shifts accumulate into a quiet reordering of the monetary system. De-dollarization, as it is often described, is not a coordinated rebellion against the United States. It is a byproduct of diversification logic. When the costs of concentration rise, diversification becomes rational. Central banks act accordingly. The dollar remains the dominant medium for trade, settlement, and financial contracts. Its network effects are immense, but reserve accumulation is no longer synonymous with dollar accumulation. Instead, reserves become more distributed across assets, currencies, and jurisdictions. This reduces systemic exposure without dismantling the system itself. Bryce S. nations exemplify this approach. Their policies are often portrayed as adversarial, but their actions are largely pragmatic. By increasing bilateral trade in local currencies, expanding gold reserves, and developing alternative settlement mechanisms, they reduce dependence without severing ties. This is not a replacement strategy. It is a redundancy strategy. Redundancy is a hallmark of systems that anticipate stress. Engineers build redundancy into critical infrastructure, not because failure is imminent, but because the cost of failure is unacceptable. Financial systems operate under similar logic. When trust becomes conditional, redundancy replaces efficiency. This transition carries implications for global liquidity. As capital becomes more selective, liquidity fragments. Markets that once felt deep and forgiving become episodic. Price discovery concentrates around key events. Volatility increases not because risk is higher, but because participation is thinner. For policymakers, this environment is challenging. Tools designed to stabilize markets assume broad participation and predictable responses. When those assumptions break down, interventions become less effective. Markets begin to test policy boundaries more frequently, forcing authorities into reactive postures. This dynamic reinforces the appeal of short-duration assets. When conditions change rapidly, assets that can be repriced quickly offer protection. Long-term commitments, by contrast, lock investors into assumptions that may no longer hold. Flexibility becomes a form of insurance against policy error. Inflation plays a central role in this process, not as a singular threat, but as a persistent background force. Inflation erodes trust gradually. It does not shock the system, it dulls it. Over time, the cumulative effect reshapes behavior. Savers demand higher returns. Borrowers rush to lock in financing. Governments rely on inflation to ease fiscal pressures quietly. This is why inflation is often described as a hidden tax. It redistributes wealth without explicit legislation. Those with assets that reprice quickly adapt. Those with fixed incomes or long-term savings absorb the cost. The system remains functional, but its incentives shift. For households, these changes manifest subtly. Traditional financial planning models assume stable real returns. When those assumptions fail, outcomes diverge. Retirement timelines extend. Risk tolerance changes not because individuals want more risk, but because avoiding risk becomes too costly. The psychological burden of this adjustment is significant. People sense that the rules have changed, but struggle to articulate how. Trust in institutions weakens, not due to malice, but due to misalignment between expectations and reality. This disconnect fuels uncertainty, which in turn reinforces short-term behavior. From a historical perspective, this pattern is familiar. Periods of monetary transition are marked not by collapse, but by confusion. Old frameworks persist long after their effectiveness fades. New frameworks emerge slowly, tested through trial and error. Those who adapt early do so quietly. Those who wait for clarity often miss the window. This is why institutional signals matter more than public narratives. Institutions move before consensus forms. They adjust portfolios not to predict headlines, but to survive environments where headlines become unreliable. The rare emergence of gold, commodities, and real assets is not a rejection of modern finance. It is an acknowledgement of its limits. Financial systems excel at allocating capital under stable conditions. They struggle when conditions become uncertain. Real assets provide a bridge between abstraction and reality. As this transition continues, the global financial system becomes more complex, not less. Multiple reserve assets coexist. Settlement mechanisms diversify. Policy coordination becomes harder. The era of simple narratives fades. For investors and policymakers alike, the challenge is not to resist this complexity, but to navigate it. Understanding how capital behaves under constraint is more valuable than predicting specific outcomes. The future belongs not to those who forecast perfectly, but to those who remain adaptable. This is the deeper meaning behind BlackRock's shift. It is not a warning of collapse. It is a recognition of change. And change, once acknowledged, cannot be ignored. As we move deeper into the second half of the 2020s, a pattern becomes increasingly difficult to ignore. Economic systems are not collapsing, yet they feel heavier. Growth continues, yet optimism fades. Markets still function, yet confidence feels conditional. This contradiction defines what can best be described as a compression decade, a period where economic activity persists, but the margin for error narrows across every layer of the system. Compression does not mean contraction in the traditional sense. It does not imply negative growth across the board or sudden financial failure. Instead, it reflects a tightening of constraints. Capital becomes more expensive. Policy flexibility diminishes. Risk tolerance declines. The same actions that once produced strong outcomes now deliver muted results. Progress slows not because innovation disappears, but because friction increases. One of the defining features of a compression decade is the coexistence of nominal growth and real stagnation. Economic indicators may continue to rise in absolute terms. GDP expands, corporate revenues increase, asset prices recover, but when adjusted for inflation and rising costs, the net benefit feels smaller. Households sense this intuitively. They work harder, earn more, yet feel no closer to security. This disconnect erodes trust in traditional benchmarks of success. From an institutional perspective, Compression alters decision-making profoundly. Long-term projections become less reliable as assumptions about inflation, rates, and policy stability lose precision. As a result, institutions shorten planning horizons. Capital is allocated with greater emphasis on optionality. Projects that require decades of certainty struggle to attract funding unless they offer exceptional resilience or strategic necessity. This shift has cascading effects. Infrastructure development slows unless backed by governments. Venture capital becomes more selective, favoring near-term monetization over distant growth. Public markets reward cash flow stability more than expansion narratives. The economy does not stop evolving, but its character changes. Risk becomes more concentrated, and rewards accrue unevenly. Labor markets reflect this compression as well. While employment may remain strong in headline terms, job quality diverges. Flexible, high-skill roles command premiums, while routine or rigid positions lose bargaining power. Workers feel compelled to remain adaptable, not out of ambition, but out of necessity. Stability becomes something to be actively maintained rather than passively enjoyed. Governments operating in this environment face a narrowing policy corridor. Fiscal expansion remains politically attractive, but increasingly difficult to finance without inflationary consequences. Monetary easing supports growth in the short term, but risks undermining long-term credibility. As a result, policymakers rely on incremental adjustments rather than decisive action. This gradualism avoids shocks, but prolongs uncertainty. Inflation, in this context, functions less as a crisis and more as a background condition. It ebbs and flows, but remains elevated enough to influence behavior. Savers demand compensation. Borrowers accelerate decisions. Asset prices oscillate as markets reassess future purchasing power. Over time, inflation reshapes expectations, teaching economic participants to discount the future more aggressively. This discounting of the future is one of the most consequential shifts of the compression decade. When long-term planning feels unreliable, short-term optimization dominates. Businesses focus on quarterly resilience. Investors prefer liquidity. Households prioritize immediate security. While rational individually, these behaviors collectively reduce long-term investment, reinforcing slower growth. Financial markets mirror this dynamic. Volatility becomes episodic rather than constant. Long periods of calm are interrupted by sharp repricing events triggered by data releases or policy signals. These episodes are not signs of instability, but symptoms of a system operating closer to its limits. When buffers are thin, even small surprises matter. This environment rewards those who understand system dynamics rather than those who chase narratives. The traditional playbook, buy growth, trust diversification, rely on bonds for stability, delivers mixed results. New frameworks emerge slowly, emphasizing balance, flexibility, and real return awareness. Success becomes less about outperforming benchmarks and more about avoiding structural mistakes. Importantly, this transition does not imply decline in innovation or human progress. Technological advancement continues. Productivity gains emerge in pockets. New industries form, but their benefits diffuse unevenly, often captured by those closest to capital and infrastructure. Inequality widens not because of policy intent, but because compression magnifies existing advantages. For individuals, the most challenging aspect of this era is psychological. The rules are not clearly rewritten. They are quietly adjusted. People sense that effort no longer guarantees outcomes, that prudence no longer ensures security. This ambiguity fosters anxiety, even in the absence of overt crisis. The system feels fairer in theory than in experience. This is why institutional behavior deserves attention. Large asset managers, central banks, and sovereign funds operate with fewer illusions. They respond to constraints directly. When they shorten duration, diversify reserves, or emphasize resilience, they are not making predictions. They are acknowledging the environment as it is, not as it once was. BlackRock's shift away from long-duration treasuries fits squarely within this context. It is not a bet against the United States. It is an acceptance that the era of effortless stability has passed. The future remains viable, but it demands adaptation. Certainty must be earned, not assumed. The deeper lesson of this period is that systems do not fail because participants misunderstand risk. They fail because participants refuse to adjust when risk changes. The institutions that endure are those that recalibrate early, quietly, and continuously. They do not wait for permission from narratives or consensus. As the compression decade unfolds, the gap between perception and reality becomes the defining challenge. Those who cling to outdated assumptions experience frustration. Those who acknowledge constraint build resilience. Over time, this divergence shapes outcomes more than any single policy or event. The global financial system is not ending. It is tightening. The margin for complacency is shrinking. Understanding this distinction is critical because it reframes uncertainty not as a threat, but as a condition to be managed. In such an environment, the most valuable asset is not prediction, but comprehension. Knowing how capital behaves under pressure, how institutions respond to constraint, and how incentives shift quietly provides a durable advantage. This knowledge does not eliminate risk, but it prevents surprise. And perhaps that is the ultimate signal embedded in institutional moves like BlackRock's. Not fear, not collapse, but realism. A recognition that the world has changed, and that pretending otherwise is the greatest risk of all. There is one aspect of this transition that institutions rarely articulate publicly, not because it is secret, but because it is difficult to communicate without being misunderstood. Financial systems can absorb stress for long periods, longer than most people expect, but when they do, the stress does not disappear. It accumulates. Quietly, invisibly, until behavior itself begins to change. This is where the real signal emerges, not in prices, not in headlines, but in incentives. When institutions shorten duration, diversify reserves, and prioritize liquidity, they are implicitly acknowledging that the future has become harder to underwrite. They are not forecasting catastrophe. They are acknowledging uncertainty that can no longer be ignored. This distinction matters because systems break not when risk exists, but when risk is mispriced for too long. At this stage of the cycle, markets often appear deceptively calm. Asset prices stabilize. Volatility subsides. Commentators declare resilience. But beneath the surface, participation thins. Fewer actors are willing to make long-term commitments. Liquidity becomes conditional, present when confidence holds, absent when it wavers. This is why moments of stress feel sharper than they used to. It is not that shocks are larger. It is that buffers are thinner. Every modern financial system relies on trust that someone will step in when conditions deteriorate. A buyer of last resort. A lender of last resort. A stabilizing authority. But when the cost of intervention rises, politically, fiscally, or monetarily, that trust becomes conditional. Markets begin to test boundaries more frequently, probing for limits. These tests are subtle at first. A weak treasury auction, a sudden repricing in currency markets, a spike in funding costs that disappears as quickly as it arrived. Each event, in isolation, seems manageable. Together, they form a pattern. Patterns are what institutions watch most closely, because patterns reveal behavior before narratives catch up. One of the most important patterns emerging today is the growing separation between nominal stability and real fragility.